Hi and welcome. I'm Steve Johnson, Chief Investment Officer here at Forager Funds, and I'm joined in today's video by Alex Shevelev. Hi Alex, how are you?
Hi Steve, well thank you.
Very kind but concerned investor of ours sent us an email after last week's Forager Australian Shares Fund webinar, concerned about my welfare and how tired I was looking. I am fine, I promise you, I'm just getting old. But one sector on the ASX that is looking tired is the tech sector. Perhaps surprisingly, we've got the newly created tech index here in Australia down some 20% from its peak. Good quality tech companies like Xero, it's 23% off its peak, and even the poster child for the growth sector, Afterpay, is now down 45% from its peak just a couple of months ago. Alex, what's happening out there?
A lot of concerns around the movement in interest rates across the world being higher, but also a lot of enthusiasm coming out of this space. And it's not just the high growth tech names. There's a lot of businesses in there that were COVID beneficiaries. The likes of a Redbubble have halved, Kogan down 60%. Those businesses really had a lot of enthusiasm implied in those share prices that have now drawn down substantially.
We've seen this across both of our portfolios, the international fund too. It's been largely indiscriminate in that space. If you report some great numbers, you get whacked, and if you report disappointing numbers, you get double whacked, has been the moral of the story. But look, there are some interesting businesses out there starting to trade at much more attractive prices. I think some of these companies had a really long way to fall. I think it's really worth thinking about their need for cash. If they're a cash burning company, then the low share price itself can become reinforcing, but we're looking at the area with a lot more interest than we've had before.
That's right. And we do own some stocks that are tech oriented and some more stocks that are growing. So we own RPM Global, which you would have read about in monthly reports. It's one of the largest positions, and it's one that really has been hitting new highs most recently. I think the rationale for that starts in the stock being largely ignored by a lot of investors, not caught up in a lot of the mania that followed COVID. Also some reasonable expectations there that are now starting to come to the fore. Life360 is another stock that's not far off its highs, despite being a US-centric growth business. Much the same setup, lower expectations, and really just starting to make itself more known to the investment community.
Yeah, and I think most of those investments are probably in the COVID reopening trade. They suffered because of COVID over the past 12 months, so people are seeing them as more of winners coming out of this. And in our portfolio, it's been the consumer discretionary side of things that did very well through COVID that's been harder hit than the tech companies that we own. But look, it's been a violent sell-off out there in this space, and we've got a good list of probably 8 to 10 businesses that we'd love to own at the right price that are a lot closer to it today. So if this goes on for a few more months, you can expect to see a few more new names in the Aussie fund portfolio.